Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Scott Nations, president of Nations Indexes, as well as Mark Sebastian, COO of Option Pit. We're here to discuss if the underlying issues in the bond market are being realized in the equity market. It's great to see the both of you as always. Mark, let's kick this off with you. It seems as if the bond market continues to tell us something else, although it's relatively calm today, and we're seeing that with the reversal in stocks. But if you look at the movement that we've had in the equity markets over the past couple of weeks, it seems as if the bond market, that the signals that it's given have largely been ignored.
Clearly, right now, we flirted with some really ugly levels on the open post the Moody's downgrade, with the 10-year note going over 4.5% and the 30-year bond going over 5% from a yield perspective. Those are the yield levels to watch. If we got a clean break in the 30-year back above 5%, that's I think maybe finally when the stock market would pick up on the fact the bond market is currently, in serious flux. The stock market's going to ignore the bond market until the last moment, until it's forced to not. And the bond market is 10 times the size of the stock market, so it should do so at its own risk. I mean, I liken it to, and believe me, this has never happened to me, but imagine having a 15-year-old kid playing video games with beats on, and you're yelling at him to come to dinner, and you yell louder and louder and louder, and then finally, you walk upstairs, you grab the kid's earphones off, and you go, "It's time for dinner." We have not gotten to that point with the stock market and the bond market yet, but if we roll over this 5% yield level, I think we're gonna have some people have made a lot of money off that bounce off the bottom. Would be a very, very good reason to sell, and would probably get some cascade selling behind it.
Yeah, well, Mark, it's so interesting. If you want to take that analogy a bit further, it's like, okay, the kid doesn't listen. Now you don't get dinner. Now you go to bed hungry. That could also be, okay, equity markets didn't listen. And then here we are trying to figure out what's next because we weren't paying attention to the bond market. I was surprised, after we got the downgrade, just how muted the reaction was. Granted, it was after traditional after hours during the week, but I mean, I don't think it was essentially flat. It didn't even pay any mind to it.
Yeah, I was surprised when futures opened up Sunday night and we were down only about 0.6%. We did get softer overnight, but then with the bond market holding those levels, and then the budget deal coming out of Congress, giving the market an excuse to buy, that has allowed the S&P 500 and the Qs to kind of just say, meh, it's Moody's. We're not going to get the blues from them. Sorry, I had to use that.
Okay, all right, we are okay. So we're beyond cheesy today. So let's bring the adult room back in the room here, Scott. What are your thoughts around this? Were you surprised by how muted the reaction was to the downgrade? It seems as if the only area of the market that's getting some noise today was within retail because of the pressure on Walmart not to cut prices. Other than that, we were down in the morning. Came back today as we speak right now at 2 p.m. Eastern. I'm surprised just how muted it has been relative to a downgrade.
I think anybody who really cares very much is in a distinct minority as far as the equity market is concerned, or even the bond market is concerned. I mean, it is not a galloping shock that somebody's going to downgrade U.S. Treasury debt. I'm not certain that the rating agencies have the sort of gravitas that they did a few years ago, and so this is even if it is surprising. This is the easiest bit of information to shrug off. Yes, the equity market, kind of a knee-jerk reaction, sold off last night, bounced back. VIX is a little bit higher. Much of that is the Monday effect. Taildex is higher. Some of that is the fact that people realize that deep out of the money put options in the S&P had gotten very cheap, too cheap. And I think maybe the interesting thing here is, Jill, that people are still willing to sell options in the broad indexes. I think they're willing to do it too quickly after a big catalyst takes the stock market down. They just tend to rush in and sell them as if they know that the bottom is in, that it can't go any lower, that they're not going to get hurt. I think that's the real danger. It's also interesting that for the first time in a long time, we've seen tail decks, that is the cost of deep out of the money puts in treasuries, climb. It seems that some bond investors now realize that the potential for a severe downdraft in the bond market is possible. What would be the catalyst? Well, this is not it. But you know what? If the Chinese wanted to teach us a lesson and dump about 700 billion, dump some of their $750 billion worth of treasury bonds to teach us a lesson while we're in a tariff battle, that would do it.
Yeah. Mark, anything that you're seeing from the volatility markets as well? You had noted some movement in the VIX. Again, it feels as if, to your point earlier, things are almost too flat, and that's concerning.
Yeah, we have VIX expiration on Wednesday, and the way that May future is pricing, the pricing right now, it's pricing that we could see volatility continue to pull back. We've seen ranges start to shrink. Overall movement out of the market, no matter how you measure it, is starting to pull back after that huge gap, and volatility markets continue to price in a pretty significant odds of the VIX continue to drop, and we've got a pretty nice contango formed across those futures, which is usually a sign of green days ahead for the S&P 500.
So what are you looking to do here? Would you potentially think about loading up on some puts here at a much more inexpensive level?
I like short vol equity, long vol bonds. Seems like because bond vol is relatively inexpensive, and as Scott mentioned, they're just starting to come in and bid up on his bond tail decks some of that downside. So, either long the S&P and hedging with downside puts in TLT or IEF or in bond futures options themselves, or you could do a play using the triple Q with TLT, because if bonds do really roll over, you saw what happened to the Mag 7 stocks. On the open, they looked really bad and then have since rallied. So if I'm interested in going long TQQ, QQQ or the NDX, I can hedge my downside with the bond market, because if the bond market doesn't roll over, market's probably just going to keep going up. But if it rolls over, that bond hedge will give me plenty of runway to figure out what to do with my long Q exposure.
So short equity vol, long bond vol.
Yes, indeed.
I appreciate both of your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.